How focused are your clients around what other people say is a very key threshold in the Treasury market, this 3% yield?
Very focused. I mean, rates are a large part of our fixed income business, and for rates investors, the 3% is a very important psychological number. We last seen that in 2014. But most importantly is what it reflects. It reflects continued momentum, continued confidence in this U.S. growth momentum story. Of course, the key thing to watch is how gradual the velocity of inflation is going to continue to come through. And we've seen some recent GDP numbers, seen some recent PCE numbers that suggest it's a very gradual and smooth entry point. And of course, the 3% number has been out there for a while, and many people have called for that 275 or 285 to 310 range, so it's not a shock.
No, does behavior change at all as rates, as the 10-year approaches that 3% marker? We're at something like 296, 97 this morning.
Certainly, what we've seen is a big pickup in volume in the first quarter of this year. Rates investors get excited when there's a dispersed set of views around where we're going to go. No one thinks we're going to stay necessarily at this rate, so I think you have some camps looking for it to go higher, some camps looking for it to go lower. What we've really seen, though, is a return to very active trading. Volumes in the market were up around 30% in the first quarter. Our volumes were up 40%, which is something we're very excited about. But yeah, we've seen a big change in behavior, and it's a very positive. A lot of people talk about this good volatility. I think that's part of what we're seeing.
Regulators are trying to bring more transparency and liquidity to the Treasury market through real-time reporting.
Sure.
This, of course, is a response to what happened way back in October of 2014, which is almost feels like ancient history right now. But what's your experience with it so far?
Look, we think the discussion's been out there actually for some time. And it is a little surprising to most people to learn that the largest market in the world doesn't have a transparency regime. And I think there's a kind of positive contagion that we see across markets. Certainly, if you look at something like swaps, where investors now understand the benefits of a transparency regime. We've had it in corporate bonds for a number of years. There's very little downside to customers having more data and more information that helps them with price discovery and execution quality.
One of the markets and swap markets in which you're active is credit default swaps, specifically credit default swap indices.
Yes.
And credit default swaps are increasingly in focus as the result of a trade and a dispute between Blackstone on the one hand, a hedge fund named Solis on the other, a home builder named Hovnanian in the middle. The CFTC has responded, ISDA has responded. From your perspective as a market maker in credit default swap indices, what's important about this dispute?
Look, I think what's important is it continues to highlight, a little bit of background. We've seen the CFTC take ownership for modernizing the interest rate swap and the credit default swap index market after the crisis, and the SEC took ownership for single name CDS. It's kind of a tale of two very different outcomes. You can see how strong and robust and competitive the interest rate swap market is now as a result of those regulations, and we simply haven't seen any activity on the SEC side to do the same thing for single name CDS. I think this will drive focus in the product, and I think it's a great time to reevaluate the benefits that could be brought to the single name CDS market of that kind of transparency and a clearer framework for clearing, for execution, so that investors can really make the product, see the product in a more healthy way.
If this trade is successful, Paul, in other words, if ISDA declares the failure to pay interest by Hovnanian, this so-called engineered default, a credit event, there's an auction, the auction clears, bonds are delivered into it, what impact might that have on the CDS market?
Look, I think anything that kind of undermines the potential robustness and safety of the product is going to be generally negative for investors. And so I think that's, again, I think this will drive a lot of focus. I don't know that we'll get to that outcome. I think that we've seen the CFTC talk about it. We've seen ISDA talk about getting it right. I'm confident the market will try to get to the right outcome here.
Let's talk about the CFTC for a couple more moments.
Sure.
Chris Giancarlo, the chairman, has published a white paper. I spoke to him yesterday. He talked to me about the need to modernize, if you will, the swaps market. He calls it Swaps 2.0.
Right. To
fix some of the errors, or if you will, imperfections in Dodd-Frank. How does Citadel look at the situation?
Look, we welcome the opportunity to evaluate the swap market framework. Dodd-Frank is now 8 years old. and it's common sense that we would look at fine-tuning some of the rules that have been out there for some time, now that we have some experience, and investors have some experience. But we can't forget that the US leads the world in terms of the strength, robustness, and competitiveness of its interest rate swap market. It is a model for the implementation of the G20.
So are you saying to the CFTC, be careful what you do here because of the potential for unintended consequences?
Well, certainly in areas we have to lock in our gains and make sure that we fix the areas that need fine-tuning. Introducing better capital requirements so FCMs can offer more clearing to more investors, that's a fabulous thing to see them focus on. Meddling with what I would say is one of the strongest and most resilient trading regimes with the advent of swap execution facilities. I mean, the clear and tangible benefits that's brought to investors is indisputable, and I think it's very important that we don't miss the opportunity to lock those gains in.
He's outlined 5 areas in this white paper in which he wants to make changes. Where do you have concerns?
I think the trading and execution piece is one that we need to be very careful to get right. Now, remember, when we started this after the crisis and we implemented Dodd-Frank, it was a little bit choppy. It took a little bit of time for the market to adapt, but we can't forget that the market has now moved on. We've seen an incredible amount of industry-led solutions. We've seen investors invest heavily in adapting to the new framework. The idea of kind of taking that away and starting again, I think there's very limited appetite. And of course, you've seen investors thrive. The big US banks are now thriving under that regime. Our model is doing exceptionally well. I think there's plenty of areas that we can focus on while maintaining that very competitive, innovative side of the market on the execution side.
Paul, Citadel Securities is one of the biggest market makers in treasuries, but you don't have a market-making business in European sovereigns. When are we going to see that?
Well, look, remember, in fixed income markets, we're entering, a world that has been dominated by large banks for 30 years. And, we continue to invest in technology and people and grow. We hired Dan Gotlander to build out our swap business last year. We hired Tony Cronin recently to build out our treasury business in Europe. I absolutely expect there's a natural affinity with our Euro swap and futures business in Europe that we would look at, product like bonds or other very liquid European sovereigns at some point next year.
At some point next year, gilts as well?
Gilts is, another question. We always got to ask ourselves when we enter a market, can we have edge over the other players in the market? Gilts is a very specialized local market. That's not to say we can't have edge, but right now, it's an area we continue to evaluate.